Welcome, everybody, to the second installment of this video series that we're doing as part of the Monetary Frontier. Today, we wanted to talk about a couple of upcoming announcements on the policy side, specifically the quarterly refunding announcement, which was previewed yesterday, and then we have an official announcement coming out tomorrow, Wednesday, January 31st, 2024, and talk about how that announcement, the supply side, interacts with QE and QT, whether there's a relationship between these things and what that relationship is, as well as connecting it to the broader macroeconomy. So with that, let's get into it.
Hey, thanks everyone for your attention and time. There's been what I basically call a game has evolved over the QRA, which is unique to the last 6 months that wasn't even considered in the prior 10 years. So right off the bat, that gets you to think, like, why the hell does QRA have anything to do with anything? Just in terms of past experience. But there's a lot of people out there, a lot of very bright and able people who say otherwise, that the QRA is explaining all the market moves yesterday, it'll explain all the market moves coming up in the next couple of weeks. QRA defines the U.S. Treasury rate, in the main, the 10-year, and then also will lead into U.S. equity, because, of course, higher rates will tighten things up and be bad for equity and vice versa, and we have a positive correlation, and so on and so forth. And what we're going to try to do is introduce some very powerful, pragmatic, common sense ideas here, which will pretty well prove, like what we have here in front of you right now, is that the QE, the amount of quantitative easing, so-called, and its flip side, QT, and you cannot have QT unless QE. You have QE. It's the Treasury can't start off with the Fed can't start off with QT, because that would be to short Treasuries, and the Fed can't do that. So it always has to be QE, and then QT, then maybe some more QE, and then QT, as we've had for the last decade. And the QE has absolutely nothing to do with the refunding in terms of like what size it is, or it doesn't blend together. And also the QRA, the quarterly refunding announcement, and then the later auction has nothing to do to the U.S. risk-free rate or curve in U.S. Treasuries. It's almost an impossibility, and I think we'll prove that pretty readily coming up. And the QRA, the big point is that the QRA is not the results. It's not like, okay, here's the QRA and then everything follows. And it is not the cause of any change in NGDP for the United States of America. In fact, it's a very minuscule factor in terms of the total makeup of the United States economy. And I think we can really just show that very obviously.
Yeah. So before we get into it, George, could you just describe at a basic level what the QRA is and then what QE is?
Sure. It seems to be confusing a lot of people that there's Q in both these acronyms. And QE is quantitative easing, so-called. It's where the Treasury decides that, well, we want reserves to go from $1 trillion to $5 trillion. So therefore, we're going to buy $4 trillion of U.S. Treasuries, are allowed securities, and then we're going to give you $4 trillion, which we insist that you put right back into the reserve system. So it's a wash. It shouldn't really be called QE. It has nothing to do with ease. It has nothing to do with tightening. It should be called, I like to call it quantitative reserve adjustment or quantitative reserve management. And then QT is the reverse. It's just that the out of the SOMA account, the Fed lets go some of their balance sheet and treasuries, maybe more, and mortgage-backed securities, takes in cash, but that's just a wash sale within the reserves of the banking system. It doesn't. There's no created. And then behind the QE is a vast and massive amounts of multi-tiering leverage of outstanding U.S. Treasury issues, which is the source of the treasuries that come into QE, and also the way that the QT is absorbed on the way back out. It's just taking off a couple levels in the apartment building is what it really is. It has no duration effect. It has no ease effect. It has no quantitative tightening effect. What's more, none of this ends up in Treasury. There's no. There used to be that the QE put a bunch of treasuries into the Fed account, and then a very small repatriation of Federal Reserve profits went to the Treasury, and it was carry and some mortgage-backed security pay downs and so on. And then that was it. And it's a very small amount. Right now, we have the opposite. We have, despite QE and the holdings of treasuries, we have a very significant loss showing up in the Federal Reserve System, which is, I'd say about 80–90% of that is from the interest on reserve balances that the Fed is paying to the banking system. That doesn't even go near Treasury. In fact, it doesn't exist. In fact, the profits which the Fed gave to Treasury didn't exist anyway. It's just a bookkeeping.
Yeah, so just to describe that a little bit. So when QE typically is ongoing, the short-term interest rate will be at zero, which means that on the liability side of the Fed balance sheet, the Fed will be paying zero on reserves, but then the treasuries that the Fed is buying will be yielding maybe 1 or 2%. So the Fed will be picking up that spread and then remitting those profits to the treasury. And right now, and for the last however many months, as the kind of treasury curve has been inverted, the Fed will be paying more on interest on reserves than it's picking up through its treasury holdings. So right now, the Fed is quote unquote like making a loss.
Yeah, but even more so, Riddick, is that the about 170 billion of interest on reserve balances, which is generated from QE, is being paid to the banks so that they're happy to hang on to this massive amounts of dormant money.
Right.
And that is recorded as a loss, but really it's almost a hypothetical. It's just not. It's just a note, and it has no real bearing in terms of the U.S. economy.
Right.
It does have bearing because the banks are making money. It does sort of turn any quantitative tightening, or so-called, or tightening of the Fed, into an ease because of this interest on reserve. But that's another story. The most important part of this is that QE and QT have nothing to do with the refunding of debt. This is not World War II, where the Fed steps up and says, okay, I'll take a third of the debt. I'll take a third of the cost of World War II. You take a third in terms of like buying, savings bonds, war savings bonds, and then we'll take a third from taxes. It just doesn't exist. That is not what's happening now. What is the Fed is on the Fed. It's on the Fed balance sheet, and it has nothing to do with the Treasury's debt requirements or their or let's say they go to a surplus. Well, it's not like the surplus that the Treasury has suddenly goes back to the Fed. There's no migration, leakage, or any sort of movement of funds from the Treasury balance sheet to the from the Fed's balance sheet to the Treasury's Treasury's account with the Fed. So it is really confusing why anyone says QE and QRA in the same breath. It's like saying, I am really excited about the sugarcane crop in Brazil, but for the dairy cows in Michigan. It's like that sort of it's absurd.
Right. So yeah, so that I would say like there's basically this persisting mythology that the Fed is like monetizing the debt, or the Fed is like directly funding the government. And that's where I think this relationship between QRA and QE that people latch onto comes from. But yeah, like George is saying, QE and QT is its own process. And then the QRA, the quarterly refunding announcement, is how the Treasury, Janet Yellen, et cetera, decide to issue or fund the government through their issuance, and whether like what composition of bills, notes, and bonds that'll be. Yeah, is there anything else, George, you want to hit on this slide?
Yeah, we could extend it to some of the acronyms. It seems like if anything has an acronym to define it, RRP, the bank lending facility, all the BLP, whatever it's called, I forget. Sorry, BTFP,
Bank Term Funding Program. Yeah,
Bank Term Funding Program. Because all they have acronyms and letters, they must be all the same thing. And it is really bizarre how people are conjoining these these terms together as if there's some sort of information that's coming out with their joining together. It's just craziness. It real cats and dogs stuff.
Great. So now I just wanted to hit a few tweets that I think describe this relationship between QRA, QE, and the economy. So the typical narrative, and George, correct me if I'm wrong here. The conventional way that people would place importance on the QRA is that the choice by the Treasury of whether to fund the next quarter of government debt, either at the short end, meaning through bills, or at the longer end through notes and bonds, or some combination of those, supposedly is thought to affect the risk-free rate, treasury yields, and in turn, risky assets, and then the U.S. economy, such that, if the Treasury came out and decided and announced that the entirety of the U.S. debt will be issued at, the 10-year maturity or the 30-year maturity, that would have a series of negative consequences for the economy by forcing risk-free rates to rise. That's the typical way that the QRA is seen as, like, being important for the economy. I think that's what's described in this tweet here, with the idea that the QRA announcements have been a major market driver. Is that a fair characterization of what the
Well,
popular
I
narrative
think
is?
I think we're being unfair to Bob, who's one of the excellent uh, analysis of the U.S. economy, macro and also monetary. I don't agree with much of what he says, but he does have an organized, disciplined approach. He's actually backing in this tweet. He was backing away from the popular discussion of what we just derided previously, and he's saying that he's just going to wait to see what happens. But he's not. He is not saying that QR has nothing to do with nothing, which is what we say. So maybe we can hold him to task for that. But at the very least, he's not plowing in and saying, I'm going to go short treasuries or buy this or do that because of it. And the chart here is this is, I like to flippantly, rudely call this pot banging, where there was a time where a bunch of primitives, if they saw the solar eclipse of the sun, if they saw the moon blocking out the sun, they go berserk and scared. I mean, it makes sense, and they bang the hell out of pots or whatever noise they want to make, and the eclipse ends. And so, therefore, they have every right to say that, given that we've been doing this ever since we were born, this is what our shaman says, and so on, that this action is what ended the eclipse. And this is just very similar stuff. Is that just because of a sentiment mass agrees on a certain point at a certain time, given such and such of indications, the market move that results is the results of the QRA. When it's not, it's just the results of the myth of the QRA that, I don't know, digital media, McLuhan, have it how you will, has moved the market. So it seems like the QRA has a big deal in terms of market myths. It's not. It's just the fact that because there's a paucity of information, there's not much stuff going on right now. The Fed has gone out of its way to avoid here and now, like what's happened this week versus next week type of analysis. The market's been sort of lost with this for about a decade. So we're therefore focused on myth and MEMS, QEs, QTs, QRAs, and so on, which has it looks like that is what's causing these market moves, but it's not. It's just the myth makers and the common agreement that this myth is what counts.
Right, right. And we'll describe this when we start to get into fleshing out our argument. But then the next I guess tweet we wanted to hit on. So the idea here is there's this idea of the liquidity that the Fed can provide and how that is a driving force for markets and for the economy, and the QRA, being a choice of whether to issue bills or bonds or notes, is feeds into that liquidity narrative. And so the idea is that, despite the Fed supposedly attempting to tighten the economy through QT, net liquidity right now is actually rising because of the way that the debt is being issued. What do you think about that?
Well, I have a big problem with the word liquidity. It's really non-existent in the United States. Anything that has a risk-free or a permanence such as the United States, liquidity has no meaning. And some of our further slides will show this. Now, Michael Howe, who did this, is one of the thought leaders in just how things work. I think he's in error in terms of taking a global position all the time. And then I think he's in error in terms of understanding QE/QT. Just as we've explained prior, QE does not go into the system. It doesn't, I always assume it is the system for the Fed right now. I apologize. But QE does not go into the economy. There is no like big valve where they crank it open and it just goes into like shots like you might see of irrigating a field. It stays within the bank system. It stays within the Fed system. It has no bearing on the U.S. economy. Same with QT, QS, quantitative support. I don't know. Another Q. It's a Q word, and a lot of these people, and Michael is actually an expert. I know from the back in the days of Solomon many decades ago. Very bright guy, but I don't think he really has a good understanding of what quantitative easing is and quantitative tightening is.
Great. And then the last point is, I think that the argument that Tweet's making here is that there's two, potential positions. Either you think both treasury supply and QE matter for setting risk-free rates and setting the treasury curve, or that neither matter, but it's you can't say that QE matters, but the QRA or the supply doesn't, or that the supply does, but QE doesn't. But George's argument actually is that QE does matter for the Fed's ability to administer a treasury rate and dislocate that treasury yield from what the true risk-free rate and risk-free curve should be, which is set by U.S. nominal growth. But the issuance of treasuries being the issuance of treasuries through the QRA and then through the actual issuance, that doesn't matter for setting treasury yields. But the fiscal programs that the government does engage in, that spending does affect the economy, and that sets risk-free rates by affecting nominal growth. Is there anything you want to say on this?
Yeah, again, this is like conjoining things that have nothing to do with each other. And I'm sort of surprised at Stephen Mirren because he did work for the Treasury. So he had all the reports and he was a very active voice at the Treasury. And this bewilders me if this is his results. I'm sure he'll get grumpy over this, but he posted it. I didn't. If the Treasury issues so much in coupon debt or whatever, well, let me back up a second. I think a huge problem that people have is they don't understand the difference of the market rate of U.S. Treasuries with the U.S. economy and the risk-free rate. Let me explain. Let's take a look at Fed funds. There is a neutral rate of Fed funds that is, let's say it's 3.5% right now. That if the Fed funds went to 3.5%, take away all the signaling and all the bull roar and all that stuff, that's likely the rate where we won't have any impact on employment, inflation, nor the economy. Getting there will be a big deal, and all sentiment junkies will kick in. But the Fed has shown that they can set the rate of the Fed funds up to 5.4, or they can set the rate down to like ZIRP. That big change in Fed funds, which is completely in the domain of the Fed, used to be only what the Fed had. They didn't monkey around with anything else to save for much. And yet you can't say that if like the 3% to 5.5% has anything to do with NGDP, any change in the economy. You can't find it. You can't like put map out the Fed funds to the NGDP evolution especially since Jan 2022, or even there's a very loose counter to that Fed funds to the NGDP, which is very noisy, but it's actually that NGDP tracks the annual change in NGDP tracks Fed funds. I mean, Fed funds go up to 10, NGDP is probably hanging around 10 in a most general average way, and vice versa. Now, when you start to, so if the Fed decides that, okay, we're not getting enough notice, I don't know why they did it, to tell you the truth. So what we're going to do is the same power that we have on Fed funds, which is just because we're damn big, we're going to extend to the 2-year, then the 5-year, then the 10-year. And therefore, we're going to, same way that we set the Fed funds rate, we're going to set the 10-year rate. And it will not be the risk-free rate, i.e. the rate that's most interactive or in sync with the US economy. It's a rate that we decide on. Now, it could be horrifying to think that the Fed doesn't even know they're doing this, that they do think the US Treasury 10-year is got something to do with the economy, which would be, I don't even want to go down that road because that's horrifying. It means the whole place should be shut down and replaced by some kick-ass MBA students from Wharton, everything. So let's say that they do know what they're doing. So they actually sit down, they say, okay, we now got 3 trillion. We're going to do a QE of up to 5 trillion. What do we buy? Okay. And what do we pay? We're not just going to take the offer. Well, we will take the offer to begin with, but we're going to drive it down to whatever rate that we administer. So it's actually an administrated rate, and it has nothing to do with nothing. It has nothing to do with the refunding announcement. It has nothing to do with QE. It has nothing to do with QT. It is the results of QE, but it's not an evolution. I mean, again, it's horrifying to think that the Fed just allowed this to happen, doesn't even know it's happening. A few people might say that that is exactly what's going on. You've said some of the MMT guys might say that. Right. But what this ends up with is that you can't use the U.S. Treasury market rate as any sort of explanation in terms of the results of the refunding announcement, or QE, or QT. But it is the rate that the Fed has decided upon, and they did do it by the Muslo QE, but it has nothing to do with any of that. So the focus on the U.S. Treasury 10-year market rate is a bit of a mystery because it has nothing to do with macroeconomics.
Great. So now let's start to get into that argument. So this is another just description of the chart in Bob's tweet, which is the S&P 500, it's the blue line, and the 10-year Treasury yield, it's the red line over the last couple of years, or since 2023. And so the general idea is, the quarter three quarterly refunding announcement came in August, and then the Q4 announcement came in November. And that, seemingly coincided with some pretty sharp turns in bonds and stocks. But so George's argument is that this isn't a mechanical linkage between the choice of announcement of issuance and the moves in these markets, but rather because enough market participants believe that the QRA does matter and moves the market in these ways, that asset markets for the time being, will reflect that change in sentiment. But ultimately, because the QRA doesn't really matter for the economy itself, that assets will ultimately reflect what they must, which is U.S. economic growth. Is there anything you want to hit on this?
Yeah, exactly. If we look at gosh, this line just lines up right with the yield. It actually was it was the day for the 10-year versus the 30-year, which gives that space. And boom, equities is just playing to bit. This is the ridiculous thing I got to say. This is one guy. This is one guy who just went out and shorted a shitload of U.S. Treasuries and bought a shitload of equity, or sold a lot of equity, and then flipped it. And he got the timing and I call them flying, then he got his troops out there, which I call them the flying monkeys from the Wizard of Oz, who just said, again, with the pot banger attitude to the eclipse, and since the market is moving with a huge size, well, the market does move like this when someone's putting like 30 billion at risk at it. But the timing of this move can only exist if it's the same person doing both legs. It can't happen otherwise. Look at Q3, quarterly refunding announcement. A lot of spiel about that. A little bit of a move, it was negative, positive correlation. People were talking about that. But then wham, quarter four, this is the way the world works. This is called the rigged market.
And the individual who you're referring to is
I don't know. I'm starting to worry about how I'm talking about it because I don't know. One of these guys they'll sue us or something like that. And
all right.
we don't have assets, by the way, just to save you the grief.
Yeah.
But And I don't think the SEC wants to go after us for saying this type of thing. They probably cheer us on. But it's very easy. I don't know. Pick a number. I think it takes about I don't know, 15 billion of shorting U.S. Treasuries to get it up, and then flipping it back to like covering your short and then buying. So 30 billion buy of U.S. Treasuries to get it go screaming down to 3 7/8. And on the equity, the way, since the correlation was close to 1, it makes sense that that was the same size in the equities. All sorts of various things. You know, you got 15 troops out there, and you say like, okay, find me 2 billion in your sector of conversions of calls to puts and back and forth, and pick out who you think's the best. You know, like, okay, just stay away from Boeing. But this is orchestrated. The market is not that, it doesn't have this finesse, especially when it's just a cockamamie, ridiculous spiel that is offered up as the reason for these moves. It's a rig.
I think this is a really cool chart, which is U.S. debt level as a percentage of the enterprise value of USA.
Yeah, and I think this is from a pragmatic point of view, this should be very convincing uh, and actually sort of definitive about how important the QRA is and how important debt levels in the United States are uh, in terms of like what the United States is in terms of its riskiness and its seigniorage, or it's almost unstaining cost of money, but for inflation. And what we have here is the debt level divided by our, on a ratio basis is a percentage of the enterprise value of the USA. Now, what is enterprise value? I use this term because this is often used for corporate finance evaluations of the firm. And what it is the debt level, the debts, all the liabilities of the firm plus its equity together, which is its total footprint in the marketplace, both debt and equity in the and for the U.S., what we do is we take the total net worth of households and endowments. It's probably important to keep putting endowments into that now, especially as the last 10 years. But it's the ownership, if you will, or the equity of the United States of America, we the people. And then we add to that the debt levels outstanding. So we end up with the total presence of the United States of America in terms of a going entity. And then we take the debt level divided by that enterprise value, of which the debt level is part of. And what we're trying to do is figure out like, well, how important is the debt level in the scheme of things? And you can see right here is that in the big picture, not very. We're right around 15%. Then we got into the GFC that raised the debt levels up as we financed various measures. Then it was coming down just a little bit below 20%. So it really hasn't moved since 2014 to present date. And this little tiny tick up here, that is the quarterly refunding announcement and all the hoopla about the deficit today. And if we look at it with more granularity, which is just basically we cut the axis down a bit, we can see that there appears to be a lot of commotion. But as we showed in the first slide, it's really much to do about nothing. And here we have the GFC, which is a very significant rise in the debt.
I think George, just make sure your cursor is running over.
Okay, good.
Yeah. See if it works now. Yeah. Okay. Great.
Okay. So what we have is a fair amount of movements in 91 up to the GFC. The U.S. economy was growing, debt was coming off, things were good. Then we hit the GFC, and it just rockets up as you'd expect with the ARRA Act and various other measures. The Fed really had little to do with any of this. If you look at it in a flow of funds, as we talked about earlier, and then it carries on, and there's a very large increase in debt, but is not really meaningful in terms of the percentage of the enterprise value of the United States. into COVID, it comes off because COVID, the remedies for COVID also raised a hell of a lot of tax receipts. It comes off, and then this right here is this is to December of last year. This is the quarterly refunding of last quarter. And then there's a fair bit, this is the quarterly refunding of the third quarter, and it's really nothing. It's very hard to get excited about this quarterly refunding in the scheme of things.
So, at a basic balance sheet level, let's take a hypothetical example of the Treasury wants to issue $1 billion of treasuries. And the typical idea is, if that $1 billion was issued as bills, then it could easily, be funded by, the RRP drawing down or something like that. And it would, take up no really like risk space. Whereas if that $1 billion was funded at like the 30-year maturity as bonds, somebody has to buy those bonds, which means that they might have to sell some equities, or they might have to sell some other security in order to raise the cash to buy those bonds. And then to sell those additional bonds, the yield on the bonds would have to rise to entice a buyer. Which means that the typical idea is that whenever you issue a lot at the long end, that should be bearish for all assets because the yield on bonds should go up and then the yield on other assets should go up. What do you think about that? Like, why isn't it from the basic like supply and demand? More supply of 30 years means the price of 30 years has to come down.
Well, first of all, this is pricing the U.S. economy entire, and it's pricing, what we've known of the U.S. economy in recent memories. Let's give it 20 years, give it 10 years, and then or let's give it 20 years so we're not tangled up in the recent Fed actions for the last decade. So give it 20 years, and then what's your forward view of the United States for the next 20 years? It would make sense that it's more the same. Maybe Democrats do this, Republicans do that, this guy does that, this and that. But I don't see any existential change to the United States in terms of a going entity, especially debt level. Like the debt level is it's meaningful, but it's not really, it's what's due to the United States given it's so powerful and is so large. They can have whatever debt level they want. Japan showed that. United States, hell, they can go a lot further. Now, as far as like where the debt is made up, there's two sides to the question of debt. One is that the deficit is only a narrow portion of the total debt in the United States. And that debt is a narrow portion of what actually is being done by by Congress in terms of programs. So you got to think about like, well, what is the duration of all these programs, all these HUD, HEW, various COVID acts? What is there? That's the asset. So what is it? I don't know. It doesn't seem to go away very quickly. So let's just give it a 5-year duration point. So then all the debt outstanding, well, we do have a good idea about that. It's about 5 years, too, in terms of like the debt outstanding. So an incremental, which is obviously only incremental as we see from this, it doesn't really matter. First of all, it doesn't really matter what the risk-free rate's going to be if they issue all 30 years or whether they issue nothing but 3-month bills. That risk-free rate is determined by the prospects of the U.S. economy over that time frame. And I don't see any existential problems for the United States out to 30 years. Now, you might think we're going to hell in a handbasket and it's going to go Argentina and all that. So, okay, God bless. Don't buy bonds. But if you look at this in terms of like the United States, based upon all the metrics and information we have, I think you're indifferent, but for duration in terms of buying 3-month bills or 30 years.
So on that point, why shouldn't issuing 30 years be worse? Like, why isn't that worse for the economy than issuing treasury bills? Or is there no difference in how it's issued?
Well, as I was saying, from an asset liability point of view, it's indifferent. What you're saying is that the 30-year could be better for the U.S. because you don't have the question of can you keep rolling it. So if anything, the 30-year, and it actually shows up in the yield curve as such, the 30 years should be a bit lower or drop down in terms of risk adjustment versus a 3-month or 5-year or 10-year. Because if I issue nothing but 3-month bills, well, I'm saying that for the next 30 years, I'm completely confident that the cost of rolling in terms of all-in interest rates will be the same as the 30-year would be. And that the only reason I would say that the 3-month bill is less onerous is because I think the shit's going to hit the fan, or there's all sorts of questions in the United States, which I don't see. What that comes up to, as long as the U.S. has seigniorage, as long as the U.S. is very likely, as likely as any historical example you could think of, to be in existence for the next 100 years, then the cost of money of 30 years versus 3 months should solely be a function of the evolution of NGDP given that setting. Does that make sense, Riddick, or am I too
Yes.
abstract?
So just to
Distinguish anything
clarify,
as I say
yeah, no,
this.
this is great. So just to clarify, when the Treasury chooses to issue at the 30-year point, and we have full confidence that the U.S. will still be a risk-free actor over those 30 years. Are you saying that that issuance should not affect the? I agree that it should not affect the true risk-free curve, which reflects NGDP expectations. And to the extent that the Treasury yield curve is dislocated from that true risk-free curve, are you saying that it shouldn't even affect the Treasury curve, or maybe that it like pushes the Treasury curve back to normalize with the real risk-free curve? Like, how would it affect each of those curves?
Actually not, it doesn't affect anything.
Okay.
The risk-free curve is defined by the various macroeconomic views on the U.S. inevitability, or where it shall be for at least the next 30 years. 12-year duration or something like that. And whether you financed all the debt that's required now in 30 years, or whether you should finance everything in 3-month bills, the end results will be the same. There'll be no impact on yield. Now, sentiment, especially because the Fed has dislocated the Treasury curve from the actual risk-free curve, which is not so much like a better curve. It's just that's where the rates are neutral versus the synchronizing with the NGDP and its progression. But if the Treasury has gone out of its way to like jam U.S. Treasuries, just like it jams Fed funds to a level that is not in sync with the economy, then we have a huge noise, or we have a huge area of what right now we think it's about 130 basis points, 1.3%. We have a pocket that could move up 80 basis points, or as the Treasury showing, it could move down 80 basis points. But that is not the cost of money for the United States. That is just an administrative effect of what the Federal Reserve's up to. That can be mistaken for just what you said. Well, if I give more bonds, less bonds, more 10 years, 5 years, it's not happening. What is happening is that market sentiment is allowed to exploit the lack of information, the lack of price discovery, if you will, to move it up and down, and especially if there's one or two bad actors get involved and want it to go there.
Right. So to clarify, the choice of whether to issue, let's say, $1 billion of treasuries at the short end as bills or as bonds, that doesn't affect the treasury yield curve. That doesn't affect the risk-free curve. But if we issue, instead of 1 billion, we issue 2 billion, and the federal government spends 2 billion because it does another fiscal program that spends $1 billion, that should affect the risk-free curve because that affects NGDP, which then should show up as different curves. So it's
Yeah,
the choice of issuance that affects the curve.
and
That doesn't
actually,
affect the curve.
the signs reserve reverse. Like
Okay.
if the U.S. government goes out and spends an increase of
Yeah.
X amount that it doesn't receive in taxes, then that will promote growth, which will raise rates,
Right.
and that could be confused with demand supply. But what it really is, and it won't raise rates that much. But when it raises rates, it's because NGDP prospects have gone up.
Yeah.
And the risk-free curve, time adjusted, it has to follow NGDP
Yeah.
time adjusted.
Yeah.
They're almost one and the same.
Yeah. So The risk-free curve reflects and GDP growth expectations and prospects for the US economy. The Fed through QE has the ability to push the treasury yield curve down below the true risk-free curve, but the Fed cannot pull the treasury yield curve above the risk-free curve because the Fed cannot short treasuries because it can only sell off the treasuries it's already bought when it does QT. So the Fed can dislocate the treasury curve below the real risk-free curve. And then when the Treasury chooses its issuance and announces its QRA, that QRA mechanically doesn't affect the risk-free curve because it doesn't affect NGDP, and it also doesn't affect the Treasury yield curve unless the Treasury says, okay, we're going to actually, unless Congress agrees to a new package and spends even more, that additional spending then can affect NGDP, which affects these curves. But the choice of whether to issue at the short end or the long end, that doesn't affect these curves.
It's immaterial. To say otherwise means that you think the U.S. is like a 1-2 year horizon before shit really hits the fan, and makes a good story, makes good memes, makes a good myth, but it's not reality.
Great. And then there's just two other charts that I wanted to hit that I think hit this point, and then we can wrap up. So the first one is this chart of the 10-year yield versus the change in the supply of notes and bonds outstanding. So I think this goes to the point where adding, issuing at notes at the long end, it doesn't have any clear correlation to the 10-year yield. You would think, more notes and bonds issued should be bearish for long-term treasuries, and when the treasury stops issuing, it should be bullish. But it actually tends to be the opposite, which is when when notes and bonds aren't being issued, that tends to be bearish for nominal growth, which then you reflects in yields. Is there anything else you want to hit on this?
Yeah, and this is an excellent chart you selected. The other thing too is you can see that. Well, first, just a statistical analysis would say this has nothing to do with anything, that they're on their own. But you can't see that and it might just because of the the smoothing of year over year. Maybe that's what we're picking up here. But the 10-year yield is is really bouncing a hell of a lot, like 1%, 2% up and down. And whatever it's bouncing around, it seems to be mean reverting to me. In other words, if you were to smooth this, you would have a line that not only has nothing to do with the red line, but it shows the wild ranges that the U.S. Treasury 10 yield goes through despite the macroeconomic setting. And I would say that while this trend seems pretty big, and I'm not going to argue with it, 1% up toward 5%, there's something going on here that's of macroeconomic importance. But the big kerfuffle that we had in the last couple of months is really a non-event. If it dives right back down to one, I'll have to apologize for saying this, but it just looks like if anything, it's a less muted 10-year yield response than we've had in the past. And it seems like things are really on track for an upward trend of the U.S. Treasury 10-year.
Right. And then the last chart is so now the red line is the share of total outstanding debt that's bills. So you can see that like in 2020, when the CARES Act was financed primarily with bills, that share of total outstanding debt jumped significantly. Again, the point is there's no clear statistical relationship between whether the debt is being funded as bills or as bonds with the 10-year treasury yield, because again, the long-term treasury rates and the risk-free curves, those reflect long-term NGDP prospects, not whether the debt today is being issued at a certain maturity or the other.
Yes, and another excellent slide you picked out here. It also shows that since there's no relationship that with any sort of disciplined approach can be defined with this, even from inference, even from like, I have a gut feel, there's nothing, there's no relationship. So I think it does a good job with those who insist there is a relationship in terms of the mythology that they're working on, the stories, the memes, how fantastical they're getting. Well, QE has a Q, QRA has a Q, there's 3 to 2. Yeah, there's all sorts of very convoluted, well, not even convoluted. There's really illogical connections going on right now, and stories and memes and discussions, which are, it's fascinating to wonder how they can be all collected under one story, because there is a collection and there's great agreement. But I think that's there's another effect going on in terms of social media and this and that, and a few bad actors maybe leading the charge. But this to try to make sense of this chart in terms of like any sort of forward-looking view or foresight is either you're a fool or you're up to no good, or you just prefer the warm comfort of a tribal belief system.
Right. And so, going off of that, the last thing I wanted to ask is from a trading perspective, if I'm putting bets on the 10-year yield. So you've made the point that basically in the short run, sentiment can kind of like dominate, the macroeconomic effects where these things show up, the QRA is announced, et cetera, and a few large buyers pull the treasuries in one direction or the other, and you have big overshoots versus where perhaps the fair value should be as a function of NGDP. Does that create a situation where, like markets can remain irrational longer than you can remain solvent kind of scenario where, treasury yields should be, if you just take into account nominal growth, treasury yields should be in the 6% range. But because Janet Yellen said, we're going to issue some bills this time, there's a huge cadre of folks that, buy a bunch of treasuries on that news. Is that a consideration for trading?
I think what it is that maybe I shouldn't trade. I mean, U.S. Treasury 10-year did hit 5%, and it did hit 3.87. And I'm, to many people listening to me, I sound like a total jackass saying that it's wrong. Okay, markets aren't wrong ever. I think where we're useful, and maybe we'll pick up our game in trading, because whenever this existed in the past, significant predatory trades can be organized to basically be like a vigilante and correct the markets. Are not going to even correct the markets, just be sitting there and catching the gore as these guys destroy. Where I think we're directly useful now is, I think we're a good idea for your risk management. If we're right, and 6% is where the U.S. Treasury 10 years is going to fit, then anytime you buy U.S. Treasury 10 years, and especially as you get more and more satisfaction from that buy, you're running a greater and greater risk of that 4% becoming 6%, because when it becomes 6%, it's not going to happen discreetly. It's going to happen despite the sentiment, which says that just can't happen. So likely it happens in a week or two. In other words, it's ruin for most people who just, in the normal course of business, they have the same sizing in terms of going long treasuries or short treasuries, given the sentiment, and where the end results will happen. In other words, 6% will happen, or NGDP is going to go down 10%. It will happen. So where I think we're useful is that for that to happen, for us to be right, it won't be a discrete move. It'll be a really fantastic, wild, God, to think I actually went long U.S. Treasuries 10 years, but I had to go to the can instead. And I missed the close of the futures type things. Even small positions can be ruined if you've been trading very successfully on sentiment, which has been a reality for a couple of years now, and you're a maven on it, and you've gotten this whole agreement amongst other people that this means that and that means this, and you're a little quicker on the finger, and you get your trades off and in, and you have stop losses, all the good stuff for trading 101. And you have satisfaction that, like, hell, I'm in great shape.
Is this basically this is what a pain trade would be?
Well, a pain trade is like a grind usually. I'm talking
Okay.
about, I can't even think of the scenario because otherwise we'd have some discrete response to it. But I'm thinking like next Wednesday, U.S. Treasury 10 years at 6%. What does that do? Because that is fair value. It's very hard to argue against it in terms of like anything we've experienced the last 40 years. Versus like, it is highly unlikely that fair value and sentiment will get us to 3%. in a sudden move. I can't see any cusp-like response, that moves down to 3. So from a risk management point of view, you have a black swan. Yeah, you have a black swan sitting out at 6%, which no matter how successful you are going long U.S. Treasury 10 years with great skill and, from Monday to Tuesday or Wednesday or even intraday, you should be aware that that black swan's floating around out there at 6%. So say I. What is not existing is a mean. Like there's the appearance. So from a risk point of view, like, okay, let's say you're running a room with about 20 guys. You should have some idea of where possible potential is. And right now it's very lipocrotatic. It's very fat tail land. And so therefore your VAR, the amount of capital that you allow people to play in one direction against that, would be ever lessened as we stay away from that. Now, that doesn't mean they don't go out and make money and they gripe and they say my bonus would have been like twice as big if you didn't like sit on me and that risk management jackass. But it would allow the firm to survive if we have that sudden movement to 6%. So all I can say is that the move to 6%, the move the S&P to 6,000 it's not going to be a discrete, VAR related, to the mean type of progression. It's going to be outside the VAR value at risk calculations, and it's going to be in the tail. And that I think is the most useful thing that we add to the to people right now.
Absolutely. Makes a lot of sense. Great. So just to wrap up, George, is there any like big final takeaways, summary kinds of points that you want to make before we close this?
Well, I think there's no doubt sentiments here. There's no doubt QRA spiel is there. I can be the South Park or what was it, the other show, the angry old man waving, shaking his fist at clouds, all I want. But I got a lot of years saying that what I say is valid. So carry on with QRA, carry on with QE, QRA and RRP, all this stuff. Carry on with it. And if you can identify that many people are in agreement with you, carry on with it. But realize that you should have some sort of risk management. If you're just a guy sitting there trading or you're in a small shop, that if you're not getting this input in terms of like what a 5 sigma move will mean, given that I'm correctly identifying the risk, maybe instead of 10 million, or maybe instead of 1 million, you should be only doing 300,000 and 30,000, and just accept the reality that you don't want to be carted out. You don't want to be ruined. And so be happy that you did the 10 million when you did it. But now you should be, especially if you're going long U.S. Treasuries, you should be shaping down to what the real value at risk, jump diffusion adjusted, or however you want to call it statistically, is probably about a quarter of what you're used to have 2 years ago, either intuitively or actually in terms of metrics.
Awesome. Yeah.
Does that make any sense at all, or is that just like me making an excuse for myself?
No, that makes sense. I mean, it's reasonable that the market will be dominated by overshoots. There's no real mean. Sentiment will dominate the cause in the interim, but ultimately bonds and stocks have to reflect the prospects for the U.S. economy over a longer period of time. And I think that'll shape up to be the reality. And at the very least, I think that we provide really great tools and approaches for managing risk and recognizing that, the black swan of a 6% treasury is absolutely out there and could come very swiftly. And I think, the mechanics show that that's a real possibility. But great. So that wraps up this week's video. We hit, treasury supply, the QRA, QE, QT, how these things are related or how they're not related. And thanks everybody for tuning in. Feel free to add questions to the YouTube video in the comments or on the Substack, or DM or reach out on Twitter to either one of us. And until next time, thanks everybody.
Thanks a lot for the respect you're showing by just listening to us. Really great slides you picked out there for me. I appreciate it.
Yep, for sure. All right. Until next time.